Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Well, thank you for joining us for a Friday Insights edition. We're going to talk about tax-free municipal bonds, and we're going to have a several-part series as it relates to this as we see this new tax environment upon us. As Congress right now, and according to the proposed American Families Plan announced April 28th of 2021, President Biden has proposed an increase in ordinary tax rates and taxpayers for at least earning $100,000 or more. And right now, Congress is debating and doing what they do as it relates to how all of this spending and proposed spending from infrastructure and the additional stimulus to the U.S. economy, how they could actually have it sort of revenue neutral, budget neutral, which really won't happen, but ultimately they're going to go for it. It's higher taxes. And I think it's not if, the question is when. Is it 2021 retroactively? It doesn't look like that's more than likely, simply because Congress is taking a long time to agree to disagree. And that's sort of why we're seeing sort of a reprieve in the markets right now. Equity markets are rising higher as a result of that. We're seeing the 10-year Treasury come in a little bit as a result of that, simply because they know that Congress won't agree so quickly as to raising our taxes, at least retroactively for 2021. Now, looking into 2022, there's a high probability by the end of this year they pass legislation that then will go into effect for higher tax rates. Now, according to the administration, as they just reported, they said it's only going to affect those $400,000 or more, high income tax bracket. Don't hold your breath, and I'll believe it when I see it, because that's really not how it always plays out, right? In the meantime, what do we do? How do we position our clients appropriately and ultimately position them in a way that we can take advantage of anything coming our way? And so we're already proactively thinking about this. We're already having client communications, but we've been doing this for years for our clients, over 25 years of my career here, and 40 plus for Rick Senior and all the team, if you will. If you take all of our collective, Don's been doing it for many years as well. So we proactively work in the space of tax-free municipal bonds, and ultimately what that means is, and I'll have multiple series on this to explain it in greater detail, but there's an incentive, a tax-free incentive, both state and federally tax-free, if you purchase the bond in the state that you actually claim your income tax. So your residency matters, but ultimately it's a double tax-free bond. The tax equivalent yield is what we're going to talk about today. And ultimately later on in other programming conversations, we're going to have how we structure the tax sort of bond portfolio, if you will, for a rising interest rate environment. So you can be in bonds for a rising interest rate environment. It's called a laddered strategy, and I'll explain that in another episode. But today, let's just talk about the cash flow that's coming to our clients in a tax advantageous way, in a tax-free way. So if you're in the state of California, if you will, high tax state, 9+%, plus the federal layering on, depending upon what tax bracket you're in, you're at 40+%, if you will. For our example here, let's turn to the board. I just did it on a federal tax rate of 40.8%, and I went back in time to March 31st of 2019 to get a sort of an apples to apples comparison of what a 40% tax would look like. And this is just federal, not incorporating state, just so you know. But here we have two fixed income, and I use the indices, if you will. So the aggregate bond index, which is the corporate tax bond index, it's A or better, if you will, for the most part in that index. So it's investment grade to the investment grade municipal bond index. So I kind of want to do as close to apples comparison, don't hold me to it, but for example purposes as possible. So if you're just in a taxable account and you have a 40% tax bracket plus, and you go into the market and you buy this bond that's yielding, or the index in this case, 2.93%, okay, so you're going to get an annual income of just 2.93% on your money for lending the money. You're going to get that money on a cash flow basis back. Well, that income is taxable. So the coupons that you receive are taxable. So you then have to go pay taxes. Well, there's an alternative that you can consider that our clients do, especially a higher net worth, are tax-free. So you would get not the 2.93%, you get the 2.32%. So a lower sort of cash flow to you, or a lower coupon you would accept if you choose to go for a municipal bond index. But if you factor back in the tax equivalent yield, meaning we take the taxes that you'd have to pay on this, what's the equivalent yield? So if you look at a taxable bond and you say, I'm at a 40.8% tax bracket, well, that's actually like getting 3.92 taxable bond by just getting the 2.32
tax-free yield. I know it's complicated,
but the reality is that it comes down to your tax bracket, your state of residence, right? And your tax filing status, single or joint, so on and so forth. So we can work together with you and your tax professional to analyze what the best sort of highest rate of return net to you. It's always about not what you make, it's about what you keep. In tax-free municipal bonds, again, highly rated. And what we do is A or better. We only do for quality with municipal bonds that have also insurance. That's what I'm looking for, backing them. So we've got some sort of safety valves built in. Again, there's risk with anything you do when you regards to investing, but for the most part in the risk spectrum, you're getting closer into the more conservative in nature when you're looking at bonds,
stocks, or equities. That being said, when you're taking a look at taxable versus tax-free, you kind of want to answer the question, wait a minute, what would benefit me the most? What I keep, not what I make ultimately at the end of the day. So we can help you at Blanke Schein Wealth Management. We can help you structure a laddered portfolio. We can go through all the basics of the tax equivalent yield to you. We can calculate that, and then we can say, wait a minute, what's the best way to structure this, especially with the yield curve and the interest rate environment and the potential for interest rates to go higher on a go-forward basis. You still can positively get
tax-free cash flow, beating the taxable bond market, as well as structuring it so that you can take advantage of rising interest rates. So I'll go into that next time. But today, our Friday Insights, just want to talk about and think about and open your mind up to strategies to prepare for higher taxes and what we're doing here proactively at Blanke Schein Wealth Management for our clients. Well, you guys have a wonderful Memorial Day weekend, and thoughts and prayers to everyone who served, friends and family, and we really are grateful for all that you've done.
So thank you, and let's enjoy ourselves, stay healthy and safe for this weekend, and take care.